I'm going to share an idea. We have oh, actually, we have time to do it. It's 2:54, so we'll potentially get a chance to do it. So this is T1, right? I'm going to try to break everything into four tranches, right? So I start the trades somewhere around, I don't know, between 45 and 60 days. Is it 42? Is it 44? Is it 48? I think they all work, whatever the case may be. I say, you know what, on a Friday, go out and find something close to 45 days. Sometimes it just works out that every Friday there is a 42 DTE expiration available. I don't know if there is one today, but the idea is to buy a long-term put debit spread and then sell a near-term naked put to potentially pay off the cost of the put debit spread. Once the short put or two puts they roll off, right? That leaves us with a pretty wide, pretty low probability put debit spread that is going to do absolutely nothing unless the market is going to sell off. And if the market is selling off, which is great for this put debit spread, what it also does, it sucks for some of the trades that we may be putting on. So look at the difference between T1 and T2. T1 and T2 have 7 days between them. So T1, I have already, in T1, I have already removed my short put, and I'm left with a pretty wide put debit spread. But T2 has been on for 14 days. I already adjusted this trade once. I entered here. We had a nice move to the upside. I was able to take off the naked puts and roll them a little bit higher. This is what I call a greedy pig roll. For those that have been trading with me for a long time, they know what this is, going back to the iron condors when we used to remove the old low priced credit spread and place a new one, right? So we're double dipping. We can roll for more credit. And this is why I started to call these, we're being greedy pigs. We set up an iron condor, and if the price stays in the profit zone long enough, one of the sides or both, right, they lose enough value, and if there's enough time, we pinch in the credit spreads on one side or both, right? We're getting greedy. We're going for the second credit, reducing our potential profit probability for additional credit. That is a greedy pig, and sometimes these pigs get slaughtered. So you have to be very careful with that. With this trade, I put it on here. This was May 9th. 2 days later, market gapped up. The short put has lost more than half of its value, so I decided to close and sell another put. And right now, we can go back and kind of look at, all right, we sold this stinking put for 25 bucks. This was the greedy pig, and now it's trading at 31. So in hindsight, from the last adjustment, right, I moved my short put closer, and the market started to kind of pull back a little bit. So the short put is really not doing any favors to me right now. The naked or the put debit spread is actually, I think it's gaining a little bit, but the problem is, right, we know that options closer at the money are more sensitive to implied volatility. So the second round of the naked put, and it's only one put, I sold it for 25 bucks. Now it's trading for 31, and that's not fun. And that's why, this trade is not in a whole lot of trouble. We could look at the delta. The delta on the naked put is still 10, right? There's a implied probability of this 5,200 put expiring out of the money is close to 90%. So my goal is to hold it. We can, maybe look at, I don't know, T plus 13, 2 weeks out. If this pullback, right, I don't know how low we're going to go. Maybe we'll pull back a little bit more, assuming that this move will continue, right? 2 weeks later, if we run up, well, this put is going to drop a lot of this premium, and we're going to be able to get out of this put. And this will leave me with November or November 21, 4,900, 46. So this is a 300 point wide put debit spread. It has a lot of time, right? It has about 180 days or something. So maybe in the next couple of weeks, if I am able to get out of this 5,200 naked put, this will leave me with a T2, 300 wide put debit spread, and that's going to add to the T1 put debit spread that's still out there, right? So this T1 is kind of guarding this T2 because if things get really bad and the market continues to push lower, right, I'm going to have to deal with this naked put, figure out where to move it to get it out of trouble and closer to safety, and to cover any potential expenses to move this naked put. I have the November 21st 300 wide in T2, and then I have a leftover put debit spread in T1, which is also 300 wide and also in the same expiration cycle. And if we look at two of these tranches combined, right, they don't look so bad. It's okay, right? This is my profit tent. We're just hanging out for now. The worst case scenario, right? We see something like, what we saw early April, where we get a massive push lower, 20% drawdown, massive spike in volatility. I think there's very little we can do to help these trades other than potentially roll them out, very far out in time. I think it's just easier to stop out and reset. And where do we stop out? If you're going to make, maybe $3,000-$4,000 in this trade, if we're down, if we're breaching the short strike, I think it's time to maybe pull the cord here, and just to avoid an unnecessary adjustments through volatility that's through the roof, and potential margin requirement expansion that could potentially put our accounts at negative equity and so on and so forth. I think the path of least resistance here is to say, look, as long as we're hanging out somewhere between the center of this tent, there's no upside risk, right? I think we're okay. The market can throw whatever they want at us. Unless the market is crashing, yes, we have to potentially deal with the short naked put at 5,200. As long as the market is not crashing, sure, we can punt this, maybe a week or 2 or 3 weeks out and down and collect a small credit. We can't really do that if the market is, completely rolling over, if volatility is exploding to the upside, because the front month is going to be super jacked up. Any potential rolls are going to be debits. And once we have a debit on the roll, which means we're extending our duration, where we are exposed to the market for a lot longer without any benefit whatsoever, I just don't think it makes sense. So maybe getting out, and it's likely to be a loss, is what it is. It's just part of the business, right? So that's where we are with these two. Now, this is a trade that I put on last week, right? So this is 7 days in. The underlying asset, which is ES, has already moved 1 standard deviation to the downside, and volatility is up from last Friday, right? So initially, these trades are not fun to hold if the market is going to go down and volatility is going to go up. But if you want to look at how this trade will potentially evolve over the next, this is, these 4 lines here represent T+0 at different points in time in the future. For example, the blue line is today, red line is T+14, so 2 weeks into the future. If we continue lower, it's not going to be fun. But if we start to move higher, or if we stop going down, assuming that volatility is also going to come in, right? What's VIX up today? VIX was up to about 25 today. When I put this trade on, right, you can see the VIX was much lower, right? So volatility is a key factor here as well. If volatility drops off, if the market just stops going down, or if we do go down, but volatility comes off, right, you can see how this is going to change over time if volatility just starts to decrease, right? This trade is going to correct itself, or it's going to self-heal. Worst case scenario, right, for this trade, if we continue lower, well, at some point we're going to have to stop out of this trade, even though I do have not a lot, but my small little put debit spread wall is getting built with, prior couple of tranches. We're not there yet. Eventually, you know, given the market is going to hold its shit together, we're going to be able to build a put debit spread wall where if we are forced to deal with the naked puts, we'll have enough put debit spreads to potentially cover any cost. For right now, again, this naked put that is, or there's actually two puts. So these two, this is a 1-1-2, right, calendar, if you will. There are two naked puts at 52.75 strike. They're currently about 13 delta. They're not in a whole lot of trouble. Once they get to about delta 20, this is my cue that, hey, it's time to get up and go do something. And what I'm going to do is, right now there's 56 days. I don't want to push it out too far out in time, but my goal is going to be buy it back for whatever the mid is. And I'm going to look for the next available strike farther out in time for at least, what I'm paying. This way I get to punt. I buy myself a little bit more time without paying any debit. And if there is a debit, then I look to sacrifice some of the leftover put debit spreads to raise the money to cover the cost. Right? So that's the idea with these hedged income trades. So I would like to keep them about a week apart, right? So you can see this one was 24 days. This tranche was entered 10 days later. Last tranche was 7 days ago, which was last week on Friday. Why don't we have a look at potentially setting up a new trade that we can do as a T4, and then from T4, I'm going to leave it alone. I'm not going to add T5, T6. No, I'm going to potentially add something to T1 because remember, T1 right now is just the put debit spread. And it's helping right now if the market is, becoming a little weak. I don't want to add any more naked puts, but if the market is going to find its way to trade higher, maybe my next move is going to be to add something to T1, right, to generate more short-term income. If nothing else, I will just wait for another naked put to come off before I put on a new trade with the naked puts. So for right now, right, I'm going to start with the long-term put debit spread. I can go with November, right? November 21. This is where my T1 and T2, and I believe T3 also is in November. T3 is December 31. This is the last day in the year. So I'm already in December. Let's just stay there, right? December 31. It's 222 days. Is that the, magic number? No. Do you want to go with 210 days? Go for it. You want to go with 222 days? Go for it. Just understand the more time until expiration, the more your put debit spread is going to cost you. That's the only difference. I don't mind going with 222 days just to stay in the December 31st. And then I say, you know what? I'm going to buy a put debit spread. I'm going to try to go as wide as I can. And the width of this put debit spread is going to be decided by a very simple number, which is what is the credit that I am looking to collect for my naked put. So maybe I'm going to sell one naked put, maybe I'm going to sell two, and I'm going to explain to you in a second. What I'm looking to do, let's say I'm going to sell a put, one or two, it doesn't matter. I'm going to sell the put, the naked put, whether it's one or two, I'm going to try to collect about $26. Right? Why? Because this is what I have been doing and this is what has been working. And look, if you want to go closer at the money, then go for a $30, $40, $50 credit. Or if you want to have a little bit more room for safety, You can go for less than $2,600 credit, but just so you know, the less credit you collect on the naked puts, the farther out of the money your put debit spreads are going to be placed. Right? I think 26 works. Until it stops working, we're going to stick with it. All right. So if I'm going to buy the long leg of this put debit spread for 80, let's call this $85. The numbers don't have to be exact, guys. Remember that. Right? So 85 is what I'm paying for the long leg. Let me get rid of this. All right. And you can see this is my long leg is way outside of the expected move for December 31st expiration. Way outside of 15% drawdown. The market, in fact, the market will have to go down 18% before this long leg is at the money, right? There's a 90% probability that this long leg of my put debit spread is going to expire worthless. There's a 10% chance that at expiration, this 4,800 put is going to be in the money. Very low probability. And I don't want it to go in the money. I don't want it to come anywhere near the money. I want this to be in place in case I need to fix my naked puts. And I'm going to look to potentially close out, roll, or whatever with these put debit spreads to give me what I need as far as credits go to fix my naked put problem. My naked puts are going to generate the income that I'm looking for. The put debit spreads are there in case if the naked puts get in trouble, to bail them out of trouble, I'm going to rely on these put debit spreads. All right. So if I'm buying the 4,800 for $85, I go 85 minus 26 or make it 25, right? To keep it simple, because I'm going to sell something for $25 or close to it. So 85 minus 25, that means the short leg of this put debit spread has to be somewhere around 60. Right? So I bought, or my long leg is 85, 84, whatever. My short leg is around 60. Difference between the two is, very close, not exactly, but very close to $25. So I'm looking for and it just so works out that this put debit spread is 300 wide. Sometimes it's 400, sometimes it's 450. Right now, volatility is up a little bit. Right, market, is trying to hold itself upright. So $25 is what I'm looking to pay for this. Now, the next step is we're going to look at the short naked puts closer in time, right? Let's try to go. Let's see if there's anything for 42 days, 45, 38. What happened to 42? There's nothing between 38 and 45. Nothing. We can go with the 45. We can go to 49 or we can go to 56. Doesn't make a difference. Really, it doesn't. One thing I do know, and this is one of those things that could potentially get you in trouble, guys, is that the further out in time you go, the less buying power requirement there will be from your broker, which kind of gives you this false sense that you know if it only takes $3,000 in buying power, I have all this buying power unused. Let me slap on a bunch of contracts, blah blah blah, and the next thing you know, again, you are way over leveraged. That's not the right way to do it. Always, always, always have to think about notional value, right? How much risk are you taking, right? And how much risk can you afford to really take? I know I mentioned this before on Discord. We talked about this real quick. If I'm selling, let's say I'm selling something for $25 or close to it. right? Maybe I'll sell the 500. If I'm selling one, let me grab my calculator so we can do some math. So 2,500 divided by 2, right? Because um, each contract here represents 50 shares of ES, right? ES is a 50 multiple. So if we were to get assigned, we get 50 times 50 is the multiple. Short strike is 2450. So 2450 times, hang on one second. Right? If we just did one short put here, it's about the notional value of this contract. Shorting a 5,000 strike put in ES is $122,500. If we did two, right, 2475, it's 247,000, right? If you're doing this in a $50,000 account and you did, let's say, two of these 5,000 puts, right? You're already 5x leveraged, 5x notional leverage. That's a lot, right? And you know, again, the goal here is not to take assignment. We don't really want to, and with futures we get a lot of leverage. The goal is not to get assigned on this short put. We're just trying to generate, short-term income and get out of the trade as fast as possible to open up something else and continue to roll these over as long as we're somewhere inside this profit tent. But just so you understand, because the amount of buying power it takes to put this trade on, it's very easy to say, well, if this trade only takes $5,000 to, or if you sell, if this is a 1-1-2 structure, right? If it's a 1-1-1 structure, I think the margin is going to be somewhere around 5,000 and 6,000 in Tasty Trade, which is a very, very light on buying power requirement, right? They give you very low entry, but then you are potentially exposed to margin expansion. So even if you assume that your buying power is 10,000, right? Which what it would be in Thinkorswim or in Schwab, right? So $10,000 to get in, you have a $200,000 account. Say, well, you know what? If I'm just going to use maybe 50% of my buying power, I have $100,000 to use. It only takes $10,000 of buying power to put this on. I can do, what's that? 10 tranches. And that's a lot, right? You don't want to leverage yourself like that. You don't want to put yourself in a position, of 5 of these tranches in a smaller account, right? Because before you know it, market goes down, volatility goes up. You have all these naked puts that are, again, going back to notional value. Your leverage 10 to 1, you have almost no room for any errors whatsoever, right? So you got to kind of think about, even though it takes very little margin to put this trade on, right? How much notional leverage are you taking, and how much risk there is? So with this trade, if we did this in a 1-1-1 fashion, right? Not 2, but 1, this will take about $5,000 in buying power in Tasty Trade, right? And what happens is our put debit spread that we're paying about $25 for is covered or paid for by this naked put that's 56 days away. So we have the put debit spreads at about 211 days, I think I said, right? 211. Let's just assume that 56 days later, this 5,000 strike put expires worthless, right? Which means the $25 debit that we paid for the put debit spread is now recovered from the sale of this naked put. Okay, so you're left with a put debit spread that is completely paid for. We have 211 days on that put debit spread minus 56 days. So you have a 300 point wide put debit spread um, with 155 days until expiration that has no risk, which means you can sell something else against it, right? And worst comes to worst, we can use that put debit spread to cover any cost of potentially rolling any other naked puts that we may have running at the time. And if nothing else happens, the put debit spread that's left over, if it expires worthless, you have lost nothing, right? So it's a free delta hedge on that put debit spread, right? So that's the idea. We can and you know we can actually use, and this is a probably a good time, you know, to mention that, you know, you can use some kind of filters, right? For example, MACDs are now starting to kind of roll over a little bit, right? We're still bullish. You can see that RSI is at 57, so we're above 50. You know, you can say the momentum is up, but things are starting to kind of, you know, roll over a little bit. We're above 21 EMA. We lost 8 EMA today, so we're still above 50 SMAs. I mean, we can't say that the market is super bearish, right? Maybe we're going to flag out and potentially, you know, continue higher. We don't know that, right? So maybe your outlook is going to be a little bit more defensive to start. So instead of selling 2 naked puts, maybe you go with 1 for now, right? You have a very small positive delta to start. So you're still net bullish. And if we continue lower, it's not going to be fun, but it's going to be a little bit easier to hold 1 naked put versus holding 2 naked puts, even if you have the put debit spread that's farther out in time. Right. So you have to introduce like this human element. You have to think like, what am I doing here? Am I selling 2 naked puts to generate more income, or am I going to start off with 1? And then in the next week or two, if things will kind of balance off and, you know, the market will find some kind of short-term support, maybe it's around 21 EMA, maybe we come down back to, you know, that 50 and we'll hold it. Okay. Maybe this 5,000 strike put is going to lose, you know, half of its value or whatever the case may be. And then you say, all right, market is now looking a little bit more bullish. Maybe you go and, you know, you roll this 5,000 strike put higher with more time to generate more short-term income, right? So it's not 100% rule-based strategy. You kind of have to think about like what's happening. What is the chart telling me? You know, am I overall bullish or bearish for the next, you know, 30 days? If we were, for example, looking at the chart, if we were already like somewhere down here and it looks like market's getting exhausted to the downside, then yeah, maybe going with 2 naked puts instead is a better deal. Why? Because we're getting more credit up front and the downside risk is not as great. But right now, I can't say that, you know, downside risk isn't great. I don't know what's going to happen tomorrow or next week or, you know, 2 weeks from now. We have already moved quite a bit, and now the market is kind of just taking a pause, the breather. Which, yes, you can make the case that, hey, isn't selling 2 puts better than selling 1? If the market takes a break here, you know, we get some time decay and potentially volatility decay and so on and so forth. Yes, but you have to be able to hold a higher net positive delta position. If you want to be a little bit more defensive, then you say, you know what, I'm going to start off with just 1 naked put. And now you don't have a positive 12 delta, you only have positive 5 delta. There's no right and wrong, right? You just got to think about what you're doing and what works best for you. Again, this is just one piece of the puzzle. The puzzle is your account. How does this fit into your overall account? Are you already long a bunch of positive delta? Then you definitely don't want to add two naked puts here, right? If you're net short delta or if you're underinvested or if you're super bullish for whatever reason, again, I'm not here to tell you that you're right or you're wrong. You get to decide, right? if you're going to do one or two or more, whatever, the structure you want to trade, right? But it has to fit in your overall portfolio of other positions that you may be holding. Right, so that's the idea. I think that I'm going to start off with just start with one. Why? Well, I'll tell you why. Because I have positions, right? I have no naked puts on T1. I have two naked puts on, or I have one naked put on T2. I have two naked puts on T3. If I'm adding T4, I have one naked put, two here, so that's three. I'm going to have five naked puts versus one, two, three, potentially four put debit spreads. Now I don't like it. Right? It's not wrong or right. Right? You want to find a balance. If I had more leftover put debit spreads, then yeah, I would probably go with two naked puts on this short 5,000 strike because I would have had more put debit spreads to potentially get me out of trouble. I don't have that right now. Right. So it's kind of like, let's start off slowly. We're going to start walking and we're walking and then we're, walking at a really fast pace and then we're starting to jog a little bit and then and then before you know it, we're running. Right. But it takes time to build up that put debit spread wall that's going to give us what we need in order to be able to take more net positive delta trades as part of this campaign. All right. Lewis says, is there volatility level when this trade is best to be opened? Again, I'm not trying to time. The best time to put this trade on was right here. And I would do like one put debit spread with 10 naked puts. But this level becomes obvious only when we're up here, right? And I'm not being a jerk. This is just the reality. So where are we now here? Well, if you tell me, look, 3 weeks from now, 4 weeks from now, we're going to be at, 7,000 on the S. Okay. Then you should definitely go with two naked puts. But we don't know where we're going to be. We just are looking at the structure of the market right now, where we are, and we're also considering other positions. Volatility, yeah, we're at, I don't know, where is the VIX today? The good old VIX is at, I should have it in front of me, but I don't. VIX is at 22. Right, 22.56. Right, VIX futures at 21.95. So we have cash VIX is a little bit higher than what the VIX future is. So VIX is at 22.45. We're definitely off the highs, right? But the market's a little nervous, right? So I don't think there's, the higher the VIX, obviously the more premiums you get and the further out of the money your naked puts are going to be. But I don't think there's one reading. Again, you can also say, you know what? This is a net positive delta. This is a bullish trade. I am not doing it unless, right, we're touching lower Bollinger Band or we're way below or we're at least 3% below 21 EMA, whatever that filter that you may be using, that's great, right? But if you just want to kind of run a campaign style where, you roll one trade into the next, your max size, and, if you have four tranches going or if you have two tranches going, how many put debit spreads you have left over, how many more naked puts you could take. Hey, I could be wrong, right? The market could take off from here. And, if there's a China deal, if there's a EU deal, or, Apple says we're going to bring back all the cash we're hiding overseas and pay massive tax bills, blah, 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 blah. Look, the market could take off from here. I don't know that, right? Given information that we have today, if I was to put this on right now, I would start with one. Look, if one isn't enough, guess what? Monday markets are closed. Come Tuesday, if that is not enough, I can always add something else to it, right? So that's my thought process. I don't think that there is, one way, the right way, everything else the highway type of deal here. You got to do what works best for you. Consider your other positions, consider how much hedges you have. If you have a lot of hedges, you can take a little bit more risk near term. If you don't have a lot of hedges, play a little safe, wait for your hedges to build up, and then we can kind of speed things up and increase potential notional leverage. All right, guys. I'm going to set this up. I'm going to try to get into this trade. I'm going to keep it simple. It's going to be a one put debit spread in December 31st expiration. It's a 300 wide. I'm going to try to sell the July 18th 5,000 strike put, which is currently around Delta 8, right? This is going currently for about a small credit. No big deal, right? So worst case, if I just end up holding the July 18th short puts until expiration, I will end up with a 300-point wide put debit spread in December 31st for a very small credit. There's going to be no cost. And hey, I'll take a free put debit spread in December 31 expiration cycle, and I can sell something else against it in next tranche and so on and so forth. All right, guys. So this is my thing here. If you have any questions, please, you can find me on Discord. Ask questions, guys. I always, always, always say ask questions, because if you're sitting around and you're not asking questions, well, then we're really not, doing you any favors. There are other members that may be in the same position as you are, sitting around and not asking questions because they don't want to sound stupid or whatever the case may be. There is no such thing as stupid, right? And if anybody makes you feel in any certain way for asking questions, reach out to me. We're going to stop that. Everybody, the reason why we have this community is for people to connect, to be able to ask questions, get answers, not necessarily argue, but debate and, look at same exact traits from different angles and so on and so forth. And, this is the only way we're all going to get better. All right. We do have a long weekend coming up. So, enjoy, be safe, spend time with your family. Have a good weekend, everybody. We'll be back next week. Take care, everybody. Bye bye.